Cement manufacturer ACC reported strong Q3 CY20 results, that's despite negative effects of coronavirus. The quarter's earnings were quite upbeat, with revenue, margins and profits all much better than expected. In our ideas for profit today, we'll focus on the strategy investors must adopt post the robust Q3 earnings now. Well, revenue was actually flat when you compare it to a year ago period. Volumes actually surprised quite positively and came in at 6.5 metric tons. That's up 2% on a year-on-year basis. Now, the cement realizations also were stable this time, but the overall realizations were negatively impacted by the weak performance of the RMC, that's ready mix concrete business, which actually plunged 43% year-on-year in terms of volumes. Now, margins benefited from the softer input costs and cost control measures. EBITDA for the quarter gone by stood at 671 crore rupees when you compare it with 556 crore rupees over the same period last year. Now, buoyancy in demand across rural markets and resumption of infrastructure and road projects aided the cement offtake as well. However, low RMC volumes continue to indicate anemic demand across urban markets. Now, as the impact of crisis gradually fades, the business should actually continue to gather momentum. With cement prices being largely stable now and trade activity gradually recuperating, the next couple of quarters are likely to be and are expected to turn moderately better than the previous one. Now, the outlook for the near term is not too great, but we do expect some positive uptick in volumes post the festive season. Now, the management has initiated several cost-saving initiatives to improve the economics of the operations as well. EBITDA per ton came at say in excess of 1,000 rupees as the steep reduction in fixed costs and employee expenses coupled with supply chain efficiencies boosted the margin profile. Now, when you look at the outlook for the margin, that also appears quite stable on the back of the steady price recovery, and that's across the global commodities. Now, following a sturdy Q3, ACC is positioned to emerge stronger post the COVID-19 crisis. With revenues returning to pre-COVID levels, ACC also has structurally improved the underlying profitability and therefore could actually surprise on the upside in the coming quarters. However, the low capacity utilization in the southern region, which is its core operating market, that remains a key worry for investors going forward. And when you talk about valuations, after dropping nearly 40% during the COVID-19 sell-off, the stock has actually recouped most of its losses or all of its losses in the past 6 months. The rally has been fueled a bit by the broader sector strength and by the general market as a whole as well. Now, in terms of valuation, the stock is trading at 11 times trailing 12-month EV to EBITDA. It is currently trading at a significant discount to similar sized peers also. So that's a positive that we are looking at. So we maintain our positive stance on the business and the long-term visibility from here on. The stock market hence however continues to remain quite volatile, so the investors could actually wait for some more pullbacks to accumulate the stock by keeping an eye on the long term for sure.